And one of the things that I think that we need to think about is when we see downturns in the market is understand that the sky is not falling despite what they may tell you on the news. Every time you see a downturn in markets, there are a group of people out there that can see it for what it is, and that is an opportunity to take advantage of that downturn and make huge amounts of money. Real estate is one of those opportunities that you should strongly consider.
Welcome to the Uncensored Real Estate Podcast, where nothing is off limits. If you're interested in buying, selling, or investing in real estate, and you want to learn some of the insider secrets and uncensored truths from the true professionals in and around real estate, you've come to the right place. Now, let's buckle up for the uncensored truth about real estate and join your host, Brian Cardenas.
Hey, everybody, welcome to the next episode of the Uncensored Real Estate Podcast. Thank you for joining us. Here on the podcast, nothing is off limits. So we love to talk about whatever topics you guys want to talk about. And we're going to do something a little bit different today than we usually do. Normally, we're joined by a guest, typically a realtor, talking about what their experiences are in the market. And what I wanted to do today is talk a lot about finance. I know I'm going to be geeking out here on mortgage finance and economic stuff too, because I think a lot of times people hear a lot of information in the media. A lot of it's just incorrect information. It puts a lot of fear out there. So wanted to clear up a lot of that stuff. But if you're joining us on YouTube, make sure you hit that subscribe button. And if you're checking us out on the podcast platforms, you can find us anywhere. Please give us a like. And if you would, when you are done listening, give us a 5-star rating. Share the episode out with anybody that you think could benefit from the things that we talk about on the podcast here, trying to help out people understand all the nuances about real estate that they typically don't understand. So want to go ahead and start diving into this because we hear a lot of talk about all the different stuff that's going on in the marketplace. Obviously, inflation is one of the big things that we hear about all the time, and we deal with it all the time when we go to the grocery store, when we go fill up our tank, when we're trying to do home improvements. Really anything and everything has been dramatically affected by inflation. And, a lot of people don't necessarily totally understand why we have the inflation that we do. So I want to kind of touch on that first of all, just to explain the why behind it. What is inflation all about and how is it impacting the housing market? Because while we experience it in our everyday lives, it's had a dramatic impact on the housing market. We all went into 2020 not knowing what was in store, that's for sure. And with that, we didn't know what inflation was going to be about. And as we kind of shut down the country because of COVID, we experienced the shortage of supply of items that we needed. Obviously, we all remember going to the grocery store looking for toilet paper and, struggling to find it, having to check in with your neighbors to see if they had any extra toilet paper. I mean, as I'm talking about this, it's just kind of blowing me away that we actually went through something like that. I actually just made a comment to my wife the other day, like there's still things that you can't get that's not available. Like I went to Costco and I've got a little, what are these coconut keto cluster things that being on keto, I need a little snack, kind of gotten addicted to those and I can't find them anymore. And so I don't know if it's a Costco thing or if it's just across the board. And it just made me think like, God, when are we gonna get back to this world where we can get the things that we want? I know I'm sounding extremely spoiled, being in the United States, not having to deal with shortage of things, but that's part of the impact of inflation. When you have supply chain issues where products can't get to market and you still have demand for those things, then it ends up driving up the cost, not just to get it produced, but to get it to market, but just competition, supply and demand that impacts the pricing of things. So we started to see that. There was, a little bit of price gouging going on, I think, with different things, getting back to the toilet paper thing. But, there was the opportunity for people who were selling goods that were in high demand and there was not enough of them. And that really is the definition of inflation. It's too many dollars chasing too few goods. So we started to experience that. As things started to loosen up a little bit and we got to the point where we had people going back into work, manufacturing facilities were opening up. We still dealt with a lot of stuff for a while. And even the Fed, who is in charge of monetary policy, there's a couple of things that they are chartered to do, and that is to keep inflation about 2% on the core rate of inflation. That excludes food and energy prices, since they don't really have any direct control over those things. They can't, help it if there's a war in Ukraine, or if a drought wipes out crops in a certain part of the world or the country. So they take those out. That's the core CPI number. They are trying to keep that at 2%. We're not near that at this point. We're in the sixes. And so what they're trying to do is they're trying to affect that. And then they're also trying to keep unemployment typically around 4%. We're actually below 4% right now. And so those are their two main charters that they're supposed to do. And the main tool that they have in their tool belt is the Fed funds rate. Now, what a lot of people don't understand is you hear interest rates, you hear mortgage rates, you hear the Fed raising rates, and the typical consumer out there thinks that when the Fed raises interest rates, they're raising mortgage rates. And that couldn't be further from the truth. They have no direct impact on mortgage rates. The Fed is actually controlling and setting the overnight lending rate that banks charge each other to lend money overnight to meet their reserve requirements. So it's a very, very, very short-term interest rate. It's an overnight interest rate. And so they set that Fed funds rate. What does get directly impacted by that Fed funds rate is the prime rate. The prime rate actually is the index that is used for most credit cards and home equity lines of credit. Those are really the two main things. And then on the periphery, it also impacts commercial lending rates. So commercial borrowing is impacted by the prime rate and the Fed funds rate. So those are really the three things that have a direct impact. So what the Fed is trying to do when they increase the Fed funds rate is they're making it more expensive to borrow. So if companies are considering making a big investment, let's say they want to build a manufacturing facility or a warehouse or something like that, and maybe it's going to be a $500 million investment. Well, if their borrowing cost was 2% at the beginning of the year, and now it's gone up to 5% on a $500 million loan, that is a huge, huge difference in what that cost of that loan. So what it starts to do is it makes companies think, well, hey, maybe this isn't the best time to invest in this. And so they slow down their borrowing. When they slow down their borrowing, they're slowing down their spending. When they're slowing down their spending, it impacts people's jobs. So they may not have as many people working on that project that they would have had if they decided not to go forward with it because of the borrowing costs. So that's one of the impacts. You also experience it personally. You might have had an interest rate on your credit card, whatever it is, 14, 15%, 20%, whatever that was. But now the Fed's been marching up that Fed funds rate, which increases the prime rate, which increases the interest rate on your credit card. At some point, it starts to impact you. For a while, it didn't have very much impact on the borrowing and the spending habits of the general public. But at some point, when they keep doing these increases and the dramatic increases they've been doing, it starts to impact people's behavior. But there's a lag time to that. It might be 60 days. It might be 90 days. If you think about it, you go charge something on your credit card today, you're not going to get a bill for it for 3-4 weeks. And then you're not going to pay it for probably another 3 weeks or so. And that's when you actually feel the impact of the purchase that you made, or maybe they increased the rates today and you made a purchase tomorrow. You're not going to see the impact in what you're paying out for probably 5-6 weeks, maybe 7 weeks. And then you may not react the first time that it happens. You may just go ahead and do it. You already bought it. You make the payment, start thinking about it the next time you continue charging. But at some point, you're going to slow down your spending. The impact of inflation also impacts people's spending habits. You might not go get the most expensive brand name, foods. You might not go get the organic produce. You might go back to the regular stuff. Everybody starts changing their spending habits, and that's what we're starting to see right now. But prior to that, the impact that inflation has had and what the Fed's role in it is the Fed wants to slow down the borrowing because they want to slow down the economy. The reason that they're trying to do that is because there has been way too much money pumped into the economy. that we cannot keep up with the demand for things, not just housing, but goods and services. If you think about it, things were shut down for a while in lots of different parts of the country. And what did the government do? They started pumping money into the economy. They started giving stimulus checks, which, we can understand when people lost their jobs, providing some support. I don't think they were quite as discretionary as they should have been, because there were certain industries that did really, really well. Like, for example, real estate and mortgage. We were all doing great through that time period, but they still set out stimulus checks. It really shouldn't have done that. Then they ended up doing a huge, massive, I think it was $4 trillion spending package as we were pulling out of it, that had nothing to do with COVID. Again, pumping more money into the economy, because the Fed, in their infinite, it's not really wisdom, I'd call it stupidity, decided, and that wasn't the Fed really, that was actually the federal government, politicians who decided that, yes, let's go put more money into the economy because we don't have enough there yet. The Fed keeps telling us that this inflation thing is transitory. It's going to get all worked out. So let's go keep spending more money. Bunch of bad judgment, bad decisions, put more money into the economy while we still did not have enough workers and supply chains opened up to be able to support that, drove up prices. With the Fed's actions at the beginning of COVID, one of the things that just about everybody recognized, at least homeowners or potential homeowners, was the Fed had to come in and they dropped the Fed funds rate down to zero. They came in and kind of bailed out the mortgage industry by buying up the mortgage-backed securities. So one thing that people don't really understand about the mortgage industry is it's very different when a mortgage banker makes a mortgage loan. If it's a local bank that's making a loan, we've all kind of probably understood the idea of how the savings and loans and banks might make loans. That, depositors deposit their money, banks hold on to that money, but then they turn around and make loans, whether it's a car loan, home equity loan, the personal loan, but also mortgage loans. When they're lending their depositors money out, it's easier for them to be able to manage that, to be able to offer adjustable rate loans, different things like that. But when a mortgage banker makes a loan, they're actually making that loan on a enormous line of credit. It's called a warehouse line of credit. And in order for the mortgage company to make money, they have to sell that loan in the secondary market on Wall Street. It gets packaged up with other similar loans into what's called mortgage-backed securities. Those are sold on Wall Street. Very similar to treasury bills and bonds, where the purchaser of those investment vehicles gets a fixed rate of return for the upfront money that they pay for it. So a mortgage company makes a loan, they sell it on Wall Street as a mortgage-backed security. They get paid more for it than what they lent out. That's their profit margin that they make, and then they can pay down that line of credit and turn around and make another loan. That's kind of how mortgage companies make their money. But the impact that the crash in the market with COVID is that a lot of companies and a lot of investors froze and stopped buying anything. And so what the Fed came in and did is they started buying up mortgage-backed securities and treasury bills to put liquidity into the market, basically keeping money flowing so that there wasn't massive shutdown and collapse in the industry and the market. And they wanted to make it cheaper for people to be able to afford going through COVID. So the idea behind that was, if we drop interest rates on mortgages by buying up mortgages, which is what the Fed did, they didn't drop the rates, they just came in and provided huge amount of demand for those mortgage-backed securities. When they increased the demand for mortgage-backed securities, lenders did not have to give them high rates of return to get them to buy them. They knew they were going to buy them. So it pushed interest rates down because they came in and provided that huge source of demand, even though the market wasn't in high demand. The government came in and created that demand artificially, which pushed interest rates down. So that's why, the Fed does not have a direct impact on the market, but they definitely have an indirect impact on mortgage rates. So as they did that, it drove interest rates down, which made it easier for people to refinance their mortgages down, save themselves on their monthly expenses, Typically, when you do a refinance, there's a month where you don't end up making a payment. So it provided a lot of payment relief. And then they did the forbearance programs and things like that to basically free up people who were impacted by COVID. So they had more cash flow and less expenses. And people were actually able to save money and pay down debts as a result of that. So there was all this money, and then all these, all of us had to stay home and not see another human being for fear of dying. So there was not a lot of demand for a lot of the services and restaurants and different things like that. So we had all this pent up demand. Mortgage interest rates are very low, and people started to see that, hey, this might be a great opportunity for us to upgrade our house. Or people that were caught in densely populated areas in New York and Los Angeles and other areas, got a little fearful of living in a condo or a high-rise condo building, and in highly populated and densely populated areas, and they decided, we need to get out of here. We need to move. So the low interest rates that were around at that point gave people the ability and the reason to be able to go purchase a new house. Or if they maybe wanted to, remodel their house, they could do that, borrow money, pull some of that equity out, and be able to get a very, very low interest rate and a low payment. So it pushed us into a situation where we created an added layer of demand for new houses based upon that low interest rate environment that the Fed helped manufacture by buying all these mortgage-backed securities. So we already had a pretty strong demand for new homes going into the COVID pandemic, because based upon looking back 33 years prior, which is about the average age of a first-time home buyer, we look back and we see that the population was continuing to grow for the next 5 years. So we know we had more people getting to the age where they were going to want to buy their first home, people wanting to, spread out, maybe get out of their parents' house, buy their first house, get married, that kind of thing. Then we had the artificially low interest rates. And we also had another big factor in the imbalance in supply and demand, and that is home builders had been building too few homes to keep up with the demand even prior to COVID. They got bit back in 2007, 2008 with the Great Recession, because they were not looking forward. They continued building more and more homes based upon the demand that was created back then by really lax lending standards. We used to say, if you could fog a mirror, you could get a mortgage back then. You could buy an investment property with zero down and a 580 credit score, and not have to say, where you worked or how much money you made. I mean, it was really ridiculous lending standards that people could get loans for. And so everybody tried to gobble stuff up. Builders kept building. And then even as the demand started to subside, builders kept building for another 2 years, way more homes than were necessary. As a result of that, there was an oversupply of homes, the demand decreased, and the market crashed. And because they got bit so bad from that, they've been very gun shy about overbuilding. So they've been underbuilding for years. They're not keeping up with the demand for housing based upon demographics. When we look at the number of household formations that are out there, we see that trend continuing to increase, but we don't see the pace of new builds keeping up with that. We're still roughly 400 to 500,000 units of homes lower than what we need based upon the new household formations. So we're not improving the home supply at all. So kind of stepping back for a minute and where we started out with the discussion on supply and demand, we had a very, very low supply of homes going into the pandemic. We have builders not building enough homes to be able to satisfy the level of demand that was there pre-pandemic. Then we go into pandemic and we have the demand that's there based upon demographics and household formations. Then we also have the desire for people to move out of city centers and get out into the suburbs and relocate, work from home, all those different things that we saw people experiencing. So now we have more people wanting to buy for those reasons. And then we enable all of that and increase the demand for new homes by having interest rates in the 2s and 3s. So we had kind of the perfect storm of all these things that created this massive imbalance in supply and demand in housing. And it drove home prices up rapidly like we've never seen in history before. So we've got this big increase in home prices. We've got low interest rates. We went through 2020 with that. We went through 2021. Back in the middle of 2021, we were starting to see the signs that there was going to be an inflation problem. The Fed, unfortunately, did not recognize that, and they continued purchasing mortgage-backed securities, keeping interest rates lower than they needed to. Finally, toward the end of the year, they recognized that they probably needed to stop this. They needed to curtail some of that demand side that they created by being the buyer of the bulk of the mortgage-backed securities in the market, which drove interest rates down and kept creating more mortgage-backed securities that need to be purchased. And so they just decided that they were going to stop their quantitative easing program and they were going to start tightening. And so they were going to do that in two ways. They're going to do that by curtailing the amount of mortgage-backed securities that they were going to buy. And then they were going to eventually start to do runoff, which is basically when a loan gets paid off, instead of taking that money and reinvesting it into another mortgage-backed security, which was their normal practice back then, they were just not going to reinvest that money. So basically, they were taking away all of their purchasing of mortgage-backed securities. They were going to spread it out over a longer period of time, but they ended up having to go much faster than they initially planned on. And then at the same time, instead of doing one thing and seeing the impact, they did two things at once, which if you ever go to the doctor and the doctor's trying to figure out, do they try different medications? Usually they'll tell you don't make changes in two things at the same time, because then you can't identify which thing was the cause of the change. They want you to do one thing at a time. Fed doesn't listen to that. They decided to do both things at once, started increasing that Fed funds rate, started decreasing their purchasing of mortgage-backed securities. And we saw basically after January 2nd, interest rates starting to rapidly increase on mortgages. Again, because they took away the demand for them because they were slowing and eventually stopped purchasing, and then increasing interest rates, which meant that less people were going to want to go out and take out mortgages, which gave us less supply. So in order for mortgage companies to be able to get Wall Street investors to buy mortgage-backed securities, they had to continually offer higher interest rates in order to get buyers. The reason that Wall Street investors were so skittish about wanting to buy mortgage-backed securities and treasuries is because of inflation. If you think about it, if you had a bunch of money and your job or your source of income was to lend money out to the public, if you made a loan for $200,000, for example, and you were going to require, let's say, $1,000 a month repayment on that loan, if everything started getting more expensive that you had to buy with that $1,000 a month in income, the next loan that you were going to make, you weren't going to be able to ask for just $1,000 a month in repayment because you couldn't afford your grocery list based upon that $1,000. So you're going to have to ask for a higher amount of repayment. So that's what ends up happening is investors, in order for them to want to buy that mortgage-backed security at a fixed rate of interest, when they have a good feeling that the interest rates are going to continue to go up, they don't want to keep buying at those lower rates, so they keep having to require higher rates in order to be enticed to buy those mortgage-backed securities. And of course, mortgage companies, in order to continue to make loans, they've got to get buyers for those loans, so they've got to offer those higher interest rates. So it basically creates a situation where you don't want to have buyers of the mortgage-backed securities on this fixed rate of return if they're anticipating that the value that they get out of that payment is not worth as much because everything they want to buy with that money is more expensive. So what actually caused the interest rates to increase is inflation and the fear of inflation. It's actual inflation, but also the fear of inflation. So when there's a fear in the market that inflation is going to be persistent, it makes the mortgage-backed securities and treasuries less desirable as an investment. The only way to make them more desirable is to get a higher rate of return each time they go and buy one of those investments. That's what's been causing this increase in interest rates on mortgages this entire year. And until last week, we're recording this right now on the 15th of November. Last week, we got a inflation reading on the consumer price index that was quite a bit lower than was expected. It actually decreased by 0.3% from the prior month. And we're now kind of anticipating that we might be seeing a trend of these month over month figures on inflation going down. We had a huge improvement in mortgage rates last Thursday when that announcement came out. And so when we look at where do we think things are going, we really heavily are weighting it on what's going to happen with inflation. So if we look at the inflation numbers from a year ago, and the reason we look back a year ago is because there's monthly inflation figures and then there's a year over year figure. The year over year figure is a 12-month rolling average. So if we're getting readings for October, it's taking October this year all the way back to September, October of last year. And what we were seeing is that the inflation figures from a year ago were actually at high levels at the end of the year. So October, November, December, January, February were all readings of between 0.5 and 0.6%. And so what we are looking at is if we are having figures, this October came in at 0.3%. So we replaced, I think it was a 0.6% figure with a 0.3% figure. That caused a 0.3% decline in that CPI rate for the year over year number. So what we're looking at is we're seeing about 4 or 5 more months where we have consistently high month over month CPI readings. If we are replacing those with 0.3 or 0.2% readings going forward from this point, then we're going to start to see consistent declines in the year over year figure, which starts to get that core CPI number to start moving down closer to that 2% figure that is the target for the Fed. Now, obviously, there's going to be some ups and downs that'll happen. It's not going to be a straight linear move downward, but we're starting to see the impact of what the Fed is doing. You've probably heard in the news, lots of layoffs with lots of big different companies, tech companies all over the place, laying off lots of people. There's hiring freezes at places like Amazon. So we're starting to see the effects of inflation and this tightening monetary policy trickle into the workplace. And that's the other thing that the Fed has been working at is they want a jobs recession. That is what they say they want to do. They want to put people out of work. That is their goal. Inflation right now is too low. Unfortunately, some of the members of the Fed don't feel like you could be actually having a recession if you have inflation as low as it's been. What they failed to look at is that in every prior recession for the last 50 plus years, a recession is always predated by the lowest level of unemployment. And then when that unemployment figure starts to turn upward, then we're very shortly after that into a recession. And that's what we actually think that we're heading toward right now. We started to see an uptick for the last several weeks in continuing claims on unemployment. And we saw an increase in new filings by 6,000 this last week. So we're now starting to see some job losses. As job losses start to occur, they will compound because as people lose their job, they will start spending less money out in the economy, which will impact different businesses, whether it's restaurants, grocery stores, service businesses, things like that. They'll have less people buying because of the layoffs. Then they'll have to start laying people off, and then those people will start spending less. So it's kind of a snowball effect that happens that as unemployment starts to go up, it will continue to go up. And so when we see unemployment start to go up, we see a recession start to happen, we start to see inflation come down, we'll start to see interest rates come down. So we have been preaching for a while with the help of our friends at MBS Highway, Barry and Dan Habib, that we anticipate mortgage interest rates to go a pretty good amount lower in the not too distant future. It's obviously impossible to predict exactly when it's going to happen. But we would not be surprised if by the springtime or summertime of next year that we see some pretty healthy decreases in mortgage interest rates.
You want to buy a house, but high interest rates have got you down? Take the rate challenge and send us a verifiable loan estimate from another lender, and we'll beat it and pay for your appraisal up to $600. Here at Give Mortgage, being powered by U Mortgage allows us to provide you with unmatched speed and efficiency and the best rates and fees in the market, all while delivering you the concierge level service you deserve. We want you to have an experience getting a mortgage that you'll never forget, and not because you got put through a meat grinder to get it. At Give Mortgage, we give great advice, we give the best rates, and we give back to charity. Visit us at www.give-mortgage.com or call us at 480-331-4684 to schedule a free consultation to see how we can help.
So the thought process that some people have in the real estate market, as to whether or not they should go buy a house right now, we see it all the time in conversations. We see it on the news, which I recommend you stop watching because there's almost nothing good that comes from that. Is the fear mongering that happens out there. They've got people convinced that the housing market is going to crash, that interest rates are going to go above 10%, all the different crazy things that I've heard. I do a lot of posting on social, and one of the fun places to go is to venture into TikTok and post some things in TikTok and just see the reactions that you get out of people, because it is largely negative, getting called names for sharing this kind of information with people. Despite the data that we have to back it up, they just think that we're saying what we want to say to be self-serving, which is definitely not the case. It's just relying on people who are really, really smart and very accurate in what they predict in terms of interest rates and the mortgage market. And what we are looking at is the fact that, number one, let's first talk about, I've already touched on inflation and where we think interest rates are going to go. Interest rates are not going to go to 10. Interest rates are going to trend down. We think that they might be starting that trend downward now, but like I said, it won't be a direct straight line downward, but we do think in the near term, probably in the next 6 to 9 months, we should probably see some relief in mortgage rates. But then the other thing that's got people, hitting the pause button in their home buying is they think, well, home prices are way too high. They're about to crash. They're going to go down 30 to 40%. They're going to lose all the gains that they've had through 2020 and 2021. So first thing to kind of dispel that myth and that fear that's out there is the thought that, we're going to have a crash like we had back in 2007, 2008, 2009. The reason that happened, I kind of touched on it before, is that we had a massive oversupply of homes. We had a decreasing demand for new purchases based on household formations. We had really, really lax underwriting standards in terms of making loans. Like almost anybody could get loans, which created a lot of the demand that really wasn't there naturally based upon the needs of people buying their first home or move-up buyers or downsizing buyers. There was artificial input there based upon the ease of getting credit to purchase a home. So we have all those factors that were going on at that time, and the things that we have going on right now is almost the exact opposite in every way. We have much tighter lending standards. We have the best lending standards or the toughest criteria in the last decade that we've ever had in our history. So people that are getting loans today actually deserve to get a loan. It's harder to get a loan nowadays than it was back then. So we have people who are qualified that show a history that they've got stable income, a good credit history, that they're willing to pay their bills on time. And typically most people have put a good chunk of money down. So they've got skin in the game, they've got equity in the property. And then as home prices have gone up over the last 2 years, now people have a lot of equity in their properties. So they're not going to let them go for nothing. Let's say they did lose their job and they couldn't get any kind of a forbearance or any kind of a workout. They can turn around and sell the house and still keep a bunch of equity in most cases. So there's not going to be a massive glut of foreclosures on the market like some people like to, get everybody fearful of. So we're not going to have those kind of situations. So like I said, the underwriting standards are more strict. There is higher demand from first-time home buyers and new home formations now than there was back then. The population is significantly higher than it was back then. And then the supply of homes is the lowest that it's been in history. Like not today, we've actually had a little bit of an uptick this year, but at the beginning of this year, we had the lowest supply of homes that we've ever had in history. And where we currently are is still well below the normal supply of homes on the market. I mean, I think we're in the range of 500,000 to 600,000 units of homes available nationwide in a country of what are population 360 or 350 million people. So we have a huge undersupply of homes. We do not have home buyers building enough homes to keep pace with the new home formation figures. So we have a persistent ongoing problem with housing supply right now. And we have an increase in demand. The only thing that has slowed demand is interest rates. And we know, based upon simple economics of supply and demand, what's going to happen as interest rates have increased from the Fed, as inflation has gone up. Those things will subside. They always do. The Fed increasing the Fed funds rate is an effective tool to slow the economy and typically push us into a recession, which brings down inflation. And with that, it typically brings down interest rates on mortgages. Pretty much, every time we look at a little chart here from back in the 70s, we've had 1, 2, 3, 4, 5, 6 recessions. One was only like a couple of months in 2020. And every time there's been a significant decrease in rates from the 4, 3, 2 plus, a little less than 1%, a little over 1%, another 1%. Those are decreases from the beginning of a recession to the end of a recession in mortgage interest rates. So we're just in a situation that's very drastically different, almost diametrically opposite of what we were in back in 2008. So anybody that's using that as a basis for, pushing fear that home prices are going to decrease by 30 or 40% is just way off target. Now, the argument that they use that home prices have gone up so much that they're unaffordable and they have to come down as a result. I could put a little bit more credibility into that, because the rapid run up in prices was ridiculous and completely unsustainable. And when you couple that with high interest rates, it does make things, very difficult to afford. There are some tools that we have now in temporary buy downs that I'll be talking about on some of my other forums. We'll probably end up talking about it next week on the podcast as well. But there are some tools to help mitigate some of the higher mortgage payments for the short term. But the fact of the matter is, things are more expensive. But one of the other things that we have seen with this run up in inflation is wages have also gone up. Now, not everybody has experienced that. Statistically speaking, if you change jobs during this time period, on average, you get about 16% increase in pay. Again, statistically average, if you stay at your job, people have seen an average of a 9% increase in their pay. So pay increases are helping offset some of the increases in the mortgage costs, but only the people who are buying new homes now or refinancing for whatever reason are experiencing those higher costs. Everybody else was experiencing the very low costs that they have at lower interest rates. Once interest rates start to come down, that will basically take all those people who have been sitting on the sidelines because interest rates went up or their fear of home prices falling back into the market as things become more affordable. If there is some moderation in home prices, most every expert that studies this stuff is not actually estimating year over year decreases in home prices. Certainly in specific markets, we've seen decreases in list prices and some sales prices. In our market, we've seen that. But there's not really too many experts out there anticipating an actual decrease in the median home price year over year for the next 5 years. Everybody is anticipating some more normal rate of appreciation in the 3 to 4% range. So if we have stable home prices, or even if they slightly go down, but over the long haul, they end up going back up, it's still a good idea to purchase real estate if you're going to hold it for the long term. If you're thinking that you might have to sell within a year or two, then I might, think that maybe this isn't the right time, because the costs of purchasing a home and the cost of selling a home may not give you enough time to see home prices go up enough to recoup that if you're thinking about short term. But if you're thinking about longer term, 3 years plus, real estate's still a good place to be. And one of the things that I think that we need to think about is when we see downturns in the market is understand that the sky is not falling despite what they may tell you on the news. Every time you see a downturn in markets, there are a group of people out there that can see it for what it is. And that is an opportunity to take advantage of that downturn and make huge amounts of money. Real estate is one of those opportunities that you should strongly consider. Again, you have to be able to afford it. You don't get into something you can't afford, but there's going to be a lot of people who will take advantage of the downward pressure in prices, make offers that are low. We're seeing that a lot where people will come in and make, pretty low offers. Now, they're not all getting accepted because not all sellers have to sell, but there are some sellers that need to sell, whether it's a job relocation or a downsizing or a divorce, death in the family, or you need to get into their first home. And so there's going to be some people that will take lower offers because they need to move on from that house. And so if you've been sitting on the sideline a little bit, especially if you're a first-time home buyer, I think this is the opportunity that you really need to take advantage of. Again, you have to be able to afford the payments where they're at today. Even if you use a temporary buy down to get that interest rate relief for the first couple of years, you need to be able to afford the payments in year 3 going forward, or year 4, depending on the program. But if you can, I would highly suggest that you sit down with a mortgage advisor and a real estate professional to figure out, does this make sense for you to go and move forward on a purchase now? Because by waiting, what you run the risk of is interest rates coming down, which it's going to happen. I hate to say the word guarantee, but it is going to happen. We don't know exactly when. If you wait to try to time things for when interest rates go down, what you can end up having happen is all of that pent up demand that's been sitting on the sidelines because interest rates were higher. There's a good chance that they're going to jump back into the market when interest rates go down a bit. And now you're going to have a bunch more competition, and you're going to have less flexibility from sellers, because right now sellers are willing to do concessions, help pay closing costs, help do interest rate buy downs in a lot of markets that they were not willing to do. The last 2 years, sellers weren't willing to do anything. They had all of the leverage. They held all the cards. They could make buyers pay over list price, dramatically over list price, waive all their contingencies, waive their appraisal contingency. And only the strongest, most qualified buyers were able to get houses at that point. And a lot of first-time home buyers got locked out of it. They just basically had to wait it out and rent or stay with family and not have that opportunity. If that's you, you don't want to be waiting again for interest rates to come down to bring all that competition back into the market, which again, supply and demand is going to tell you that if there's increased demand, still a limited supply, because that supply is not going to go up, you're going to start seeing prices go up again. So all the leverage that you have right now in terms of getting a better price, getting seller concessions to help buy that interest rate down, make things more affordable for you, it's going to go away when interest rates go down. I can promise you that. Sellers are not going to be as forgiving. They're not going to give you what you're asking for. You're going to be back to competing with multiple offers again. So you're really hurting yourself by waiting. It's much easier to go out and get a property now that you want, and then when rates come down, you should have the opportunity to refinance into a lower rate. I say should because that's another piece that you need to consider in all this, that you need to have a mortgage advisor that's going to give you all the options. I'll tell you, sometimes as loan officers, they can very easily default to what's the easiest or what's the lowest payment today. For example, you have a conforming or conventional loan, or you have an FHA loan. If you've got high credit scores and you're doing the minimum down payment, 3% on a conventional, 3.5% on an FHA loan. If you have high credit scores, you're probably going to have a lower payment going with the conventional loan. Even though it's a little larger loan, you're putting a little less money down, because the mortgage insurance cost is likely to be much lower than the mortgage insurance cost for FHA. Even though FHA's interest rate will probably be lower, that mortgage insurance cost plus the amount of the upfront mortgage insurance that FHA requires that gets financed into the loan, the combination of those two things typically makes the higher payment on an FHA on that minimum down. But on a conforming loan, let's just say, play devil's advocate, you buy a house today, and let's say the home value in 9 months or a year from now has gone down by 5%. It's possible. If it goes down or even stays the same, and then interest rates drop and you want to take advantage of a refinance, you may not have enough equity there to be able to refinance. So you would be locked out of being able to get that interest rate lower unless you could come up with a bunch of cash to pay that loan balance down to have enough equity to do a refinance. So there's some risk involved by going with that type of financing on a minimum down payment loan. Whereas FHA, you probably pay a little bit more in your payment, but in essence, you can think of it like you're paying for a little insurance that you will be able to refinance if rates go down the road and home values happen to drop. Because the unique thing about an FHA loan, also VA loans have this, is you can do a streamlined refinance that does not require an appraisal. So they don't care what the value of the home is. If you've been on time with your payments for the last 12 months, you would be eligible to refinance on a streamlined refinance. Even if you change jobs and your income change, it's a really simple, easy program to take advantage of that lower interest rate. So you have to have somebody that's going to give you those options and talk you through those, because it may be important to make that choice for a slightly higher payment today to put yourself in a position where you could refinance even if home values did go down. And that would be able to get you into a lower payment that you wanted and deserve, quite frankly, because it had nothing to do with you if home values went down to where you wouldn't be able to get a lower interest rate. So I think those are the things that you have to consider with all this. It's much easier to fix the interest rate or make a change in the interest rate down the road than to be in a situation where you're in massive competition and starting to have to overpay or waive contingencies and get the house that you want just because you tried to time the interest rate for your home purchase. So that's the thing that I would recommend to people that are contemplating getting into the market or whether they should wait for a little while. I think there's way more benefits by getting in sooner than there is by waiting and trying to time things. And so I really encourage anybody that's thinking about buying their first home, get in touch with the mortgage advisor, get in touch with us, get in touch with a real estate agent, look and see what those opportunities are. What are the things that are available to you? There is down payment assistance out there if you haven't been able to save up a ton of money. We rarely were able to use that during the last couple of years because of the competition that was out there. Now you can take advantage of the down payment assistance programs that are out there. Sellers are willing to give money to help cover some of your costs. So you'll typically be able to get in with much less money now than you would have been able to over the last 2 years. And then even if you're thinking about investing in real estate, again, same situation. You can negotiate better deals. You have less competition. You don't have to overpay for properties anymore. Yes, your interest rate's going to be higher today, but typically with investors, you're putting a good chunk of money down, and it typically will put you in a position where a refinance opportunity will probably be there when interest rates do go down a little bit. So as an investor, we've got several investors that are purchasing properties. There's investors that are buying, multiple properties because they see the opportunities that exist in the market when the mass populace thinks, this is a bad time. They fear a market crash. They fear, rising interest rates. So they get paralyzed and don't do anything. The people who understand the opportunities that present themselves now are the ones who are taking advantage and can build massive amounts of wealth. So don't let the media and what, people that you talk to, family, friends, what have you, that are negative on housing, negative on interest rates or anything like that, don't let them fill your head with fear. You do need to make smart decisions. You need to have advisors who study this stuff on a daily basis, who've been doing this for a long time, that can back up their opinions with facts and historical precedent so that you can make wise, informed decisions. So that was what I wanted to go on a rant about today. Hopefully that was all understandable. I know sometimes it can be like drinking from a fire hose. Definitely did not want to do that, but that's the beauty of a podcast. If something kind of went over your head or you wanted to re-listen to it, you can rewind and re-listen to it. And I highly encourage you to do that. See the opportunities that are out there. Don't live in fear. Take advantage of the things that are presented in front of you. And if you need some advice, always feel free to reach out. We're here to answer questions. We've got the backing of a nationwide company. So if there's a market that you're in that we're not in and we can't help you, we can definitely connect you with professionals in your market that will put your interests at the forefront and do a great job for you and give you the right advice. So again, thanks very much for joining us here on the solo version of the Uncensored Real Estate Podcast. Who knows? We'll see if we do this again in the future. But tune back in next week. We're going to have another guest joining us, and we'll have some more great information for you. Please make sure that you subscribe and like and give us 5-star reviews. And we look forward to seeing you guys again next week. Take care.
Thanks for joining us, and please remember to go and subscribe, like, share, all that cool stuff to help us grow, and come back to listen to our next episode. Until then, go out and live life uncensored.
Thanks for listening to the Uncensored Real Estate Podcast. Don't forget to help us out and subscribe. Follow and give us a 5-star rating on your favorite podcast platform. And check us out on YouTube for the full video podcast. If you want more information on any of the topics discussed on today's episode, email us at uncensoredrealestatepodcast@gmail.com or give the Cardenas Mortgage Team a call at 480-331-4684.